All right. Hello. How are you today? I hope you're doing great. As you can see, I have a different setting going on here. I am traveling at a national options conference, and I want to make sure that you can hear me. So please, let's see here. I guess I'll have to open the Q&A box. Please head over to the Q&A box. Okay, Nitish, you can hear me? Great. Can you guys see the Q&A box? Can you see the Q&A box? Oh, you can? Okay, well, I will shut that and minimize that. All right. Well, today, friends, we're going to talk about cash secured puts or put credit spreads, which are best. Before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. All right. Well, for those of you who are not familiar with me, let me introduce myself. My name is Dan Passarelli, and I am an author of three actually best-selling options books. Do you believe that? That's crazy. I never really even paid attention to this stuff until my new book came out. And it turns out that the first book I wrote like 15 years ago is still on the bestseller list. I had no idea. In the category of options, of course, not like competing with Harry Potter or anything, but yeah, so I guess that's great. Um, and I am also a trader, been trading a long, long time, and I still trade. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. And I collaborate with a lot of good people in the options trading industry, including options friendly brokers like Firstrade, for example, as well as exchanges, software providers, etc., etc., etc. I'm a family man. Got my wife, Kathleen. She did not come with me on this trip. Sometimes she does, sometimes she doesn't. She's at home with my little teeny weeny dog, hanging out, watching Netflix at night, holding down the fort, running operations with Market Taker during the day, and my two adult children. And I do things for fun. I'm a runner, although when I'm on vacation like this, I don't get to exercise as much as I'd like to, or at least that's my excuse. Foodie, I do get to eat a lot of good food though, and I'm traveling, and I'm a music person. Now, I mentioned that I have three um, popular, actually best-selling options books. Build Consistent Wealth has been pretty consistently in the top five best-selling books on Amazon in the category of options. Recently, I haven't looked at it in a couple of days. Um, and also there's another category. It was in the top 10. So um, it's actually a pretty well-received book. And I'm glad about that. I'm proud about that because, man, I spent a lot of time and effort and thought working on it, putting in literally decades of knowledge. I think, Trading Option Greeks is consistently ranked in the top five by basically all the lists of the top options books. I think this one is better than Trading Option Greeks. It's very different. This one is all about covered calls and cash secured puts, which we're talking about today. So if you haven't picked it up yet, now would be a good time. Get out your phone here, go to the camera app, aim it towards that funny looking box. The QR code is what it's called. On the right-hand side of your screen, it'll pop up a little yellow thing. Click that and order it right now. And if you do order it right now, tell them you did so in the Q&A box. Or if you ordered it already even before now, let me know. I would love to hear how many of you have actually signed up and joined and got the book and taken your investing further. All right, well, let's get into the topic Doger, cash secured puts versus put credit spreads. So, what is cash secured put? Cash secured put is selling a put. Usually it's out of the money, not always, but usually. And then we call it a cash secured put because you hold cash to potentially buy the stock if you get assigned on your put. Um, so really, like if I were king of options, which I'm not, um, but if I were, I don't know who king of options is. I don't think there really is one. It's sort of a democratized sort of thing. But if I were king of options, I would not call these cash secured puts because you're not securing the put by cash, you're securing the potential stock purchase with cash. So I don't know. There's probably a better name. So what does this look like? Well, it looks like this. Let's say we're looking at our Firstrade option chain, and we decide to sell the 255 puts on whatever stock this is. Doesn't much matter what it is. We sell them at $4.35. Well, what does that really even mean? We're selling short, right? We're selling something we don't have. But, with options, it doesn't really matter. Buying and selling it's almost just sort of an accounting term. We're taking the short side of a contract, what's called the short side of a contract. Someone else is taking the long side. It's a contract between me and somebody else. And because we're the sellers, we're getting paid $4.35 a, uh, a share per contract. So if we sell one of these puts, we're collecting $435 because each put represents 100 shares. Now, it's always best to think about this from the buyer's perspective. And I know I'm breaking this down fairly basic. And I know some of you attend these week after week and you know this stuff already, but there's always some new folks here too. So bear with me just a second. I want to help these new folks out a little bit. So we're selling these to someone who's buying them from us. The person who bought them from us, they own the right. All contracts have rights, right? They own the right to sell the stock to us at $255 a share. And they're paying for that right. They're paying $4.35 for that right. So that means that, I mean, it wouldn't be a contract that has a right in it if somebody else wasn't compelled to perform. So we as the sellers have the obligation to buy 100 shares at $255 if the person who owns these decides to exercise the right to sell it to us. Now, when will they exercise the right to sell it to us? This is where a lot of people who are new to puts sort of get confused. If the stock is anywhere below $255 at expiration, we're very likely to get assigned. In fact, the Options Clearing Corporation will automatically exercise them if the buyer doesn't do anything else, which means we'll get assigned if the buyer doesn't do anything else. The buyer can call up Firstrade and say, hey, listen, don't exercise these. Even though the stock's lower, I don't want to sell them at that higher price. It's pretty rare, but it happens occasionally. So if the stock's anywhere below 255, we're going to buy these shares at 255 bucks. But we still get to keep the $435. So let's take a look at what that looks like. Strike price is 255. We sold them at 435 bucks. Whoops. If the stock is anywhere still above 255 bucks at expiration, well, the options expire, the put expires, and we get to keep that $435. If the stock is anywhere below 255, we get assigned and buy the stock at 255. So the lower it goes, the worse. But because we get to keep the $435 or $435 a share, let's state it in those terms, we don't actually lose money until the stock is $4.35 less than 255. So that's $250.65. So basically, if we start out with the stock here somewhere above 255, presumably, if it goes up, we make money. If it stays the same, we make money. If it goes down a little bit, we make money. So they're high probability trades, but if, the stock really tanks, we do have a pretty good amount of risk on our hands. I mean, technically, we can lose $250.65. We're trying to make 435 and we can lose, 50 times that. So there's another choice here, selling a put credit spread. So that's selling a put, usually one that's out of the money, just like selling a cash secured put, but instead, we're not necessarily holding any cash. We hold some cash. I'll tell you about that in a minute. But instead, to protect ourselves, because that's kind of what the cash does, right? It keeps us out of a situation where we're getting margin calls and having leverage losses. Here, the way we protect ourselves is we buy a farther out of the money, lower strike, put as protection. So here, we're basically doing the same thing we did before, selling the 255 put at $4.35. But then we're buying the 252 and a half puts at $3.40. So we sell at 435, buy these other ones at 340. So we're taking in a credit of 95 cents. So there's a lot going on here. I mean, first, without even looking at the P&L diagram or, whatever, what's one of the glaring things that we notice? One of the glaring things we notice is that we're collecting only about 20% of what we collected on the cash secured put. We're not collecting 435, we're collecting 95 cents. So we're collecting a lot less. So what kind of implications does that have? Why would we do that? Well, here's why. Still, if we're above 255, we do hit our maximum profit because both of the options expire. And we get the 95 cents. So, okay, only 25 or only about 20%-ish of what we made just selling the put cash secured. But the here's one trade-off. If the stock goes down and is below 255 at expiration, technically, we would get assigned, we'd buy it at 255, but we only have 95 cents of a credit. So our break even is actually much higher. We don't have all that other, $3.60 or whatever, a wiggle room. And then, so that's like sort of, that's two detriments, right? Make less, break even's worse. But the big benefit comes in where we don't have all that downside risk. Here, instead of the most we can lose being 250 some bucks, here the most we can lose is $1.55. Yeah, $1.55. So we risk significantly less, significantly less. Okay, is that trade-off worth it? Well, look, here's the big answer. Sometimes it is, and sometimes it's not. So let's take a look-see here. We got cash secured puts on one side. Well, I make more if I don't waste all that money on the long option. Why would I waste all that money? Oh, I get to buy the stock at a lower price, kind of like a limit order. Huh. I worded that kind of funny, didn't I? I get to buy the stock at a lower price, like a limit order. I didn't say I have to buy the stock. I mean, I do have to, but it's perspective. To me, it's I get to. Next, but spread traders are smelly. Yeah, it's true. I didn't know if you knew that, but it is it is there's several white papers that prove that. Okay, for put credit spreads, I have less risk with the credit spread. Okay, well, there's a benefit. How about this? With put credit spreads, I get stuck buying stock higher than the market if I get assigned. Well, hold on a second now. Wait a second. Just wait a second now. Either way, I'm selling the 255 puts. Either way, I'm getting assigned at 255. I'm buying the stock at 255. Now, we factor in the credit on both, and it's a little worse with put credit spread. But here I'm saying I get stuck buying the stock higher than the market when assigned. Get stuck. Hmm. I'm not saying I get to buy the stock. I'm saying I get stuck buying the stock. And the other very sophisticated argument is that cash secured put traders are dum-dums. Now, those are pretty fighting words. Like it's a scientific fact that put spread traders are smelly, but to call cash secured put traders dum-dums, I don't know about that. I think that's a little bit offensive, don't you? So just having a little fun. Because, what else are we going to do? It's really a matter of perspective, but, perspective is reality. It really is. Tree falls in a forest and nobody hears it, doesn't make a sound. Well, there's some science to that, but there's some philosophy to that. Well, it's the same thing here. There's science to it, but it becomes a matter of perspective as well. Both of these are viable strategies. They are. But there is a right answer, but it's personal, it's situational, it's opportunistic, it's objective driven. Which one do I do? Cash secured puts or put credit spreads? I do both. I do some when I have one objective, and I do the other when I have the other objective. Let's look at some trades. Oh, wait. Let's consider. Well, actually, no. You know what? Let's look at some trades. I'm going to stop the share for a second because, you know, I'm on my, I've only got one screen. I didn't bring an external monitor like I usually use. So I've got to pull up, I got to pull up my first trade count here. Buddy. What? Oh, well, that's weird. Yeah, I gotta look up the password and such. First. Ah. Let's try that again. Ah, there we go. That was a weird thing. Now we got the verification code. Okay, so here we go. Uh, I guess I can share my screen again. There we go. Okay. Who wants to give me a trade to look at? I'm going to literally hold your hand and walk you through the process. Not literally. I'm not literally going to hold your hand, but I literally am going to walk you through the process. How about somebody gives me a a trade idea where you might consider a cash geared put or a put credit spread? Oh, Eduardo, you just got the new book? Oh, thank you, man. I really appreciate that. You like running trails or road? Gene, I didn't cease these questions afterwards. Um, I like running. There is a paved trail in my town. It's like a bike path slash running path. And there's like trees on both sides. There's actually like a ridge. Sometimes there's people's backyards. It's a very, very nice, beautiful trail. That's what I typically run. Now that I'm getting old, I don't want to twist my ankle. My favorite travel destination, Italy. I've been to a lot of places. Italy is my favorite. And Edward, I'd never met a trader before. I'm an investor. I'm wondering what's the mentality of a trader versus investor. I think you as a trader might be a higher risk taker than an investor. Edward, I'm glad you asked that because that's really what today's workshop is all about. Basically, like the moral to the story, the punchline is cash secured put traders are investors, put credit spread traders are traders. To me, 95% of the time, that's the difference. It is possible to be a trader with cash secured puts. And I talk about that in Build Consistent Wealth with Options. I'm kind of promoting my book a little bit on this trip. So I happen to have them with me right here. Build Consistent Wealth with Options. And I talk about mostly investing, but I talk about trading with them as well. So yeah, cool, man. I'm glad you asked that. Okay, so Gene says Intel. So here's the thing, Mean Gene, Intel. What is your objective for the Intel trade? And what is the criteria? Ooh, Amalfi Coast. The Amalfi, yeah, I'll tell you what, man. Probably the Amalfi Coast. Yes. I mean, it doesn't get better than the Amalfi Coast. I did, in fact, the last time we went to Italy, we went to the Amalfi Coast first. Well, we went to Naples first, then the Amalfi Coast, and a little stop in Rome. But the Amalfi Coast is beautiful. And then we went and stayed at what they call an agriturismo in Tuscany. And if you've never done that, put it on your bucket list. It's actually it can be a less expensive way to see Italy. And in a lot of ways, it's a better way to see Italy. An agriturismo is a working farm. Um, and so it's really cool. You just use that as your home base, and it's amazing. Okay, so Intel, Mean Gene, what is your criteria for the Intel trade? What is your objective for it? Sometimes I ask people this, they say, well, to make money. Okay, yeah, to make money, right. But you can make money a whole bunch of different ways. You get a side job as a bartender, you can do real estate. Why do you think it's a good idea to trade Intel in this regard? Uh, and Gene, I need you to answer so I don't wait too long because otherwise people are going to be like, come on, Gene. And there's going to be a mutiny on our hands. They're going to. So either give me some rationale behind it or we'll just go on to a different person. We'll come back to it, Gene. Okay, BRKB. Scott, BRKB to own at a lower price. Okay, now we're talking. That is an objective. Wants to own the stock at a lower price. So that is, I don't know if you've thought of it this way, Scott, but that's an investor's objective, an investor mentality, right? So, okay, you want to own BRKB at a lower price. So let's take a look then. So we'll go to trading stocks, BRKB, B. Oh, sorry, my brain's not working today. There we go. Oh, well, darn it. That's a symbol not supported here right now, I guess. Sorry about that. So we got to do something besides BRKB, but I guess we can still talk it through, Scott. So if my objective is BRK.B, you think? Okay, I can try that. Oh, Berkshire Hathaway. I see. Berkshire Hathaway. Okay. I was thinking that was Interactive Brokers. Yeah, Berkshire Hathaway. So let's look at a chart. So that's the 1 minute. We're going to need the 1 day candles. Oops. For 1 year, we still need the 1 day candles, I prefer. And let's squish it down here. Let's see, this is May. So this is about where we live here, right? So yeah, we look at this and we had a bottom here in August, but that doesn't really count, I don't think. That was that was an anomaly. So we kind of had a double bottom, triple bottom here, busted through it. We're looking like we're reaching support here. And I mean, we are reaching support here. So the question becomes, to me, the question is, what is your criteria for wanting to buy it? Like, let's drill down more. Your criteria for the trade is to want to buy the stock. Okay. What is your criteria for wanting to buy the stock? This is like an outline. The high level, want to buy the stock. That's Roman numeral 1. Okay. Capital B or capital A and B and C. What are my reasons for wanting to buy the stock? Is it purely technical? It's at a low price. Let's see here. See if Scott gave us more information here. No. Okay. So is it purely technical? It's gotten down to this level, and I think it's going to bounce back higher. Or is there some fundamentals involved? Or is there, one can make a case for saying, when you buy a company, what you're really buying is the abilities of the people at the running and working at the company. And that's fair reason as well. So for me, when I'm looking at cash secured puts, my primary rationale is usually fundamentals. I'll look at the PE ratio, I'll look at the dividend yield, I'll look at the book value, I'll look at the operating cash flow, price to operating cash flow. I will look at the debt, so the quick ratio. But I'll also look at fundamentals too, or technicals too. I like selling puts or put credit spreads in down markets like this because that's when the implied volatility gets higher. So we can possibly sell some really expensive options here. Let's check in with Scott here. More upside than CDs. What about the same risk with the same amount of cash? Is that based on dividend yield? Is that what you're saying? Or just expected appreciation? Oh, the premium covers the lack of dividend. There's not a dividend. I forgot if there's a dividend. Okay. So expected upside appreciation likely to be better than CD is what Scott's thinking here. Okay. Okay, great. So here's what I like to do. One, and this is straight out of Build Consistent Wealth with Options. What PE ratio do I think this is a good buy? If there's dividends, what dividend yield do I think is a good buy? And then I'll just kind of do a little algebra, reverse the math. and figure out what price does it have to be at to get to my P ratio or to my dividend yield. Additionally, I'll say, well, look, here's support. There's strong, solid support. I want to sell a put at or below support. So let's see what puts I can, let's see what puts I can even sell. Get option chain. Go. Call splits near the money. Okay, and go. And go. Oh, geez. My computer is working like a piece of junk. I need a new computer. I'm going to get one next week. Okay. Well, anyway, if my computer wasn't running like such trash, my computer wasn't running like such trash. What I do is I look for a strike below support, which was 465, at or below support. And I'll just, I'll do a little math and I'll see what kind of return I can get on that put. And if it's worth it, then I trade the put and I try and put myself in a profitability fork. I kind of just made up that term, but it's a good one. I hope I remember that one. A profitability fork. I wish I came up with that before and in time to put it into build consistent wealth with options. But a profitability fork would be like if I don't get assigned because the stock stays where it is or goes up, I make a good annualized return. If the stock goes down and I get assigned, excellent. I've met my objective of buying the stock. And then, like Scott said, you can sell calls against it and you keep the wheel going, right? Yeah. That's where the real value of this stuff comes from. But if I were to sell a put credit spread, that kind of messes everything up for me. Because if I don't get assigned, I don't get as good a return unless I scale it and sell, probably 4 spreads for every 1 cash cured put. But then if I get assigned, I'm buying 4 times as much, and that's probably way more. I mean, it is way more than I would want to. If I want to sell 1 put to buy 100 shares, but I have to sell 4 put credit spreads, then I end up buying 100 shares, I'm over leveraged. Or if it goes down too much, I don't buy any shares and I hit a maximum loss and my position goes away and now I just locked in a loss. So using a put credit spread is not conducive at all if I want to get assigned. It actually works way against me. Oh, thanks, Gene. Okay, well, I don't know what. Oh, what I like to, okay, there's Gene. What I liked about Intel for 515, sell the put at 105 or sell the 105 puts at $5.05 and buy the 101 put at 355. Yes, but Gene, here's what I need to know. Is your objective to get assigned and own the shares, or is your objective to skate and just keep that cash and you really don't want to get assigned? This is the first question you have to ask yourself. Skate and keep the cash. Okay. So there already, I'm leaning away from cash secured put, right? So now, now we look at Gene's trade here and see if, you know, if it makes sense, if maybe a cash secured put is better, or if maybe, hey, maybe there's put credit spread that works out better. Okay, so Gene's looking at the 515 strike. Let's check this out. I'm pretty into this here right now. I find this interesting. So one day, let's try and get this to about a year. Oh, geez, so we just gapped up again today. Golly, this darn thing's on fire. Okay. So that's another thing that comes into play is volatility. Now, Intel has a lot of wind in its sails. And, we knew that from way back here when the Trump administration announced that they were taking a 10% stake in it with warrants to buy more, almost 10% stake, as I recall, if they sell off their foundry unit, I think it is. So anyway, you got a lot of wind in their sails. There's a big push from the government to get chips manufactured in the US, and Intel has that capability, but they've just been sort of letting it die on the vine. And so they're trying to reinvigorate it. So, okay. I think you said sell the 101 puts that expire May 15th, which is 10 days away. So this would be, it would have to retrace this gap over the next 10 calendar days, which would be 8 trading days. About 7.5 at this point. And, they say gaps are meant to be filled, but, I doubt this gap's going to get filled. I doubt this one is or this one is. I wouldn't be surprised if this just keeps going and these gaps never get filled, but this is the bet. Do we end up filling this gap? Right? So, okay. And he doesn't want to own it. He's just betting on we don't fill this gap, basically. I don't know if I'm putting words in your mouth here, but well, that's not what I said. Options. Oh no, this one, options. What is it called? INTC. So we'll look at the May 15th expiration. Oops, we got to go a little more. Is to go all. So can sell the 101 puts. Oh, wait, you said 105 puts, right? Oh, okay. Okay. So basically, still, just maybe it's just a little bit more aggressive. Uh, if it fills the whole gap and you did nothing to manage it, um, you would hit your maximum loss. But A, you'll probably manage it. But B, you're betting against that happening. Oh yeah, I know what you're talking about here, Gene. I bought some, I bought some even lower, but I've been trading covered calls on it, which was a great thing for a while, and now I'm, leaving some money on the table, but that's okay. Okay, so you're looking at selling the 105 puts and buying the 101 puts. So basically selling these for 485, buying these for 340. So right now that's $1.45. If you were to sell the 105 puts, I mean, you just have massive downside risk. If it went down to, well, if it went down to 101, you'd actually still have a winning trade. But it's just that this one has had such a hyperbolic move over the past few weeks that you probably don't want to take that downside. But I mean, because like, look, the break even, sell it at 105, you collect 485, your break even's $100.15. So if it just went to 101, you're better off selling the cash gear put. But I mean, it's not a crazy thought to think that this could fall to 70. Intel could come out tomorrow and say, yeah, well, we've been working on these deals, and they did announce some deals. I think one with Amazon, if I'm not mistaken. But, it's going to take us 10 years to get our act together. Well, then, right back down. So a trade like this, you really would not want to do a cash geared put. This is one where there is way too much downside risk. But is 101 the best strike? Is 105 the best strike? For me, I always try and anchor the short strike to something tangible, usually a support line. Now, you don't have a support line on that chart until way lower. You got where it fills the gap, which is right at about 101. So I almost won. Okay, and what's your risk reward selling the 105, 101? You can make $1.45, but you can lose 265. So you can lose too much, 2 times what you stand to make. Well, okay. Lose 2 times what you stand to make. It's not horrible, but you're gonna have to sell. Well, it depends on how big your account is. If you have a $2,000 account, you're gonna sell one of these and be happy. If you have a $50,000 account, selling one of these is stupid, you know, unless you're looking at it as super speculative. Okay, so what if instead you sold maybe the 103 puts? Well, then, geez, I mean, you still collect practically as much, right? $4 instead of 485, and you still buy the 101 puts. 4 minus 340 is 160. No, is 60. So you collect about a third as much, but you have an extra $2 of wiggle room. You can lose 60, or you can make 60, but you can lose $1.40. Yeah, so I mean, it's still about the same amount of risk reward. What if you did take it down to where it would have to fill the entire gap. And you sold the 101 puts at 340 and bought the 99 puts at two. You could probably buy these at about 270 CBH. So 330 minus 270 is 50 cents. No, is 60 cents. Wow, you can collect just about the same amount of the 103, 101. So you collect 60 cents and your risk is $1.40. So hold on a second. If you're thinking about this in terms of your risk reward instead of dollars and cents, your risk reward on the 101.99 put credit spread is the same as the 105, 101 put credit spread. And then you can say, but yeah, Dan, but I make $1.45 here. I only make 60 cents here. Well, whoop-de-doo. Why don't you sell two of these? Then you make $1.20. And you have way more wiggle room and really about the same risk. I'm just talking this through, and you know more what's right for your, well, you know what your objective is, but that might help you meet your objective better. Don't you think? I kind of think it might. You're like, yeah, yeah. Interesting. Do we have time for one more? I think we have time for one more. Nvidia has gone down so much, and it may not go further. Yeah, Armin, but what criteria is that based on? And Justin, what criteria is the KMB based on? I mean, it may not go down further, you're right, but it may go down further. And that's right too. So we need data-driven trades. We need something to hang our hat on. KMB is, oh, what is KMB's dividend? 5% yield? That's not bad, right? Okay. So this, okay, so there, if part of your objective is to capture the dividend yield, you really want to get assigned. So so I'm guessing, Justin, that it having fallen from 144 to 96 benefited its dividend yield. It doesn't pay more dividends, but the cost you pay to get those dividends makes the yield higher. Is that right? But, you know, in situations like this too, you have to try and ascertain what's the chance of them cutting their dividends. And, you know, that's not necessarily always easy, but there's usually rumblings about it. If, you know, you can look at like their quick ratio or whatever, excuse me, to get a feel for how's their cash looking. Are they able to pay off their debts with, you know, short-term cash that they're earning? And if they are, then they're probably not likely to cut their dividend because they want to keep long-term investors as, like you pointed out, an aristocrat type stock. Now here's something interesting too. When it was at 120, their dividend yield must have been lower than 5%, right? Because that's how the math works. So then you might not have wanted to buy. I don't know what it was then, maybe 4%. But if you target a 5% yield, you might put in a good till cancel order to sell the puts at a 96 strike, because that's where, if you get assigned, you lock in a 5% yield. Uh, Gene, I don't think I'm going to get time to get to all that. I apologize. Because we're kind of coming up on it. So if I want to get that dividend yield, I'm not going to mess around with a put credit spread. It is just silly. But then you might say, yeah, but Dan, what if something bad happens either in that stock itself or the market in general, and the stock falls to, 90 or 85 or 80, goodness forbid. Well, if you bought it here because you like the 4% dividend yield, then you'll love it here with 5%, and you really love it if the stock's down at 85. Well, it actually, I guess if you get assigned and you sell the 96 strike puts, you still locked in a 5% dividend yield. In a sense, it doesn't matter if in the short term the stock goes to 85, because your objective is not capital appreciation, it's dividend. If you think that the stock is never going to reach 96 bucks again, well, honestly, you might still hold on to the stock and keep the 5% dividend yield if that's what makes you happy with this. Because it's locked in either way. You paid X and you get the dividend stream based on X. But, it's probably unlikely Kimberly Clark, goes down and never sees this price again. So, short-term losses with these things, that's why I say cash geared puts are investing, not trading. I'm personally okay taking short-term losses, even if they last 3 months or whatever. I'm fine with that. Cool. All right. Well, speaking of having learned something today, that's all we got, friends. Okay. Until next time, which is next week, trade smart, and I'll catch you next time. Bye.